It's a beautiful morning right here, Friday morning right here in Lagos, Nigeria. Great to have you join us. I'm Ladi Williams. First off, let's kick off now with what's in the news today. We see oil prices rose today despite thin market liquidity after a week marked by worries about Chinese demand and haggling over a Western price cap on Russian oil. Brent crude futures rose by 28 cents to trade at $85.62 a barrel in early trade, while U.S. WTI crude futures climbed 49 cents from Wednesday's close to $78.43 a barrel. There was no WTI settlement yesterday due to the U.S. Thanksgiving holiday. Both contracts were still headed for their third consecutive weekly decline, on track to fall about 2%, with worries about supply easing. And the federal government says the country needs a total of $410 billion or $10 billion per annum to achieve its energy transition plan by 2060. The Minister of State for Petroleum Resources, Mr. Timipre Silva, made this known at the 7th meeting of National Council of Hydrocarbons in Minna, Niger State. Mr. Silva says that Nigeria is committed to achieving the carbon neutrality, end energy poverty, and drive economic growth. He adds that Nigeria will be one of the 50 countries to launch its guidelines for carbon emissions in the upstream oil and gas sector latest this year. And achieving 95% financial inclusivity for Nigerians in 2024 forms the heart of conversations holding at a two-day hybrid international financial inclusion conference held in Abuja and hosted by the Central Bank of Nigeria's National Financial Inclusion Steering Committee. At the opening ceremony, the head of the committee and governor of the Central Bank of Nigeria, Mr. Godwin Emefiele, drew a parallel between financial inclusivity and economic growth. Our correspondent, Kayla McGrath, was there and filed this report.
Nigeria's Unbanked has drawn stakeholders from 4 continents to this two-day hybrid international financial inclusion summit holding in Abuja. The first of its kind since Nigeria launched its national financial inclusion strategy in 2012, a response to the 2008 global economic meltdown. And according to the chair of the strategy's technical committee, a lot has improved in the last decade.
We've improved financial inclusion to 64.1% from 53.7% when we started. This is despite remarkable population growth annually over that same period.
Nigeria's financial exclusion rate dropped from 46.3% in 2010 to 35.9% in 2020. However, the country has not met its 2020 target of reaching 80% of its population with financial services. According to the governor of the Central Bank of Nigeria, only 65% of Nigeria's population is banked.
Various up-to-date researches and painstaking analysis show a positive correlation between financial inclusion rate of a country and its GDP growth. As such, our focus on financial inclusion was imperative to ensure sustainable development and growth in the Nigerian economy.
Speakers at the event identify many of the disparities affecting financial inclusivity in Nigeria. Issues with broadband penetration, gender inequality, and poor education on the need for financial access. President Muhammadu Buhari, in his speech, read by the Minister of the Federal Capital Territory, notes that all is being done to reach rural dwellers.
The plan was focused on economic recovery in the short term and sustained growth and development in the long term. Farmers were required to open a bank account to access this facility, and this marked the first time many of them had accounts and has consequently led to the growth of financial inclusion amongst this underserved segment.
The revised National Financial Inclusion Strategy, the Women Agent Framework, the National FinTech Strategy, and Payment System Vision of 2025 are also launched at the event. Moving Nigeria's banked figures from 63%, which it is here in 2022, to 95% in 2024. That is the goal. And the strategies to get that done is what's going to be discussed here in the next few days, bearing in mind the very important correlation between access to financial services and economic growth of Nigeria. Kayla Megwa, Channels Television News.
Now to our first conversation. As inflation stays elevated globally, about 14.4 trillion naira contributed by retirement savings account holders, or RSAs, face the risk of losing value to currency depreciation and inflation. Let's talk now to Wise Chigudu, partner in insurance leader EY West Africa. Join us right here in the studio. Great to have you.
Thank you very much for having me.
Yeah, so these investments, looks like they stand a massive risk, right now, from currency devaluation to inflation. Is like a double, whammy at this time. What do you think PFAs, that's a pension fund administration, what do you think they can do, at this time to kind of hedge these investments?
So it is important, thank you very much for bringing this up. It is important during a time like this to actually look at the impact of this inflation. First of all, on those that are still contributing. I'm talking to the younger members of the pension schemes that are making contributions towards their pension funds, and those that are near retirement and the retirees. So let's start off with the first category, which are the younger people. Inflation, what normally happens is that as you have this high inflation, wages begin to catch up over time. So there shouldn't be much of a worry for them, because they continue to contribute 10% by the company, 8% by themselves to the pension schemes. And as their wages go up, then it provides that hedge.
And we did get that report that wages are not growing as fast in Nigeria. So that's another problem.
Yeah, it is a problem, but there's always a lag. So eventually, it's very much an economic principle. If people are not getting enough, then they start looking for jobs elsewhere, or they begin to japwa, which is a big Nigerian phenomenon at the moment. So as wages catch up, then over time you would expect those effects to counteract. It's the retirees that are the problem. The major role of the PFA is to provide security and moderate and appropriate returns on the investments that the pensioners are making. And that's what they do when they buy the bonds. The bonds give certainty of income, and they also give security, since most of them are FGN bonds. I think about 73% of the investments, according to the latest reports, are going to FGN bonds, which provide that security of income. But inflation, of course, is ravaging the value of those investments, which is the unfortunate outcome of the war in Ukraine and the inflation that it has imported into Nigeria.
Right, and obviously, currency devaluation, that's another, big problem. And most of these investments are denominated, in the Naira. Well, what are the other options, really?
Well, it's interesting. The whole idea of how you make investments for pensions is to match the outgoes from the investment, the inflows from the investments to match the outgoes for the pensioners. So pensioners' income is denominated in Naira. So what you don't want to do as well is to create a currency risk when the inflows that are coming in are no longer matching the outflows that are going out. So as long as the Naira is stabilized, and we can see the CBN taking measures to try to arrest the depreciation in the Naira, then that would become less of an issue.
And there's no point introducing some kind of foreign currency that's more stable, maybe the greenback?
Well, we're introducing a currency now. That's
maybe they can invest in more dollar-denominated, assets.
Well, the current global investment climate, unfortunately, driven by the war in Ukraine, the effects that we're seeing in Nigeria now are being experienced globally. It's not just a Nigerian phenomenon. In fact, there are economic forecasts that seem to suggest that the West is going to go into a period of stagflation as well. So it's not a panacea to the problems we are facing.
Right, and I saw a recent report, and it indicates that the PFAs, underperformed inflation and MPR in the first 9 months of this year. Yeah. What do you think? What's your reaction to that? So, it's quite scary.
It's really scary, but it's really important for us to understand once again that the drivers of what we are seeing now are exogenous. The inflation is imported from global events. And we are going to inevitably go through a period of stagflation, which is a period where you have high inflation and you also have high interest rates and you have slowing economic growth globally. So this is something that we're going to have to ride through.
Right through. And yeah, obviously, you know, when you come to your retirement, and I remember a story, you know, about what happened in Europe at some point when the retirees got to the end and they found out that all they contributed for all their life could only get a cup of coffee. You know, that happened.
Yeah. It can happen. It can happen. What we can look at is expanding the universe of assets that PFAs can invest in, and start including more assets that provide that inflation hedge, which is one of the issues we currently have in the market, that we have got that restriction. Number one, inflation-linked bonds. You know, in more developed markets, they have these inflation-linked bonds which provide a certain hedge. Whenever inflation goes up, the income or the coupons on the inflation-linked bonds also go up as well, which provides some level of protection to retirees. Number two, more investment into real assets. So just having, including some, so real assets are basically commodities. And allowing pension funds to have some direct exposure to real assets, because real assets tend to also track inflation. So for instance, right now globally, as you know, crude oil is going up, and as a result, it provides any direct exposure to that, provides that inflation protection that you need. But I think we just need to start having a lot more access to assets that are either linked to real assets or are actually inflation-linked bonds issued by the FGN.
And it looks like the PFAs are limited with, you know, the kind of investments, you know, they can make at this time, because according to the law, they can only, you know, invest in specific, you know, investments. What do you think? Should there be some kind of amendment to allow them, you know, diversify, you know, as far as they can?
Yes. So the whole point behind putting those limits, of course, is to ensure the security of pensioners' assets and to ensure that PFAs don't take undue risk in investment portfolios. But increasing the universe obviously improves the level of diversification. At the moment, what the PENCOM has done is issue regulations that say how much of a particular security can invest in, and there are only maximum limits. So those maximum limits are meant to protect pensioners' assets. So the availability of more of those assets that PFAs can invest in can actually also help in allowing for diversity and also diversification, and also to allow for inflation proofing.
We did get that a new law to allow, you know, contributors, you know, take some of that pension and use for a mortgage. How does inflation and, you know, rate hikes, how does it impact, you know, what you can actually use to maybe start some kind of mortgage, you know, out of your pension contribution?
There have already been some adjustments to regulation to take account of that. I think you're allowed up to 25% of your RSA to contribute towards a mortgage. So yes, there is that provision already. But more importantly, it's in an environment like this, there's always panic, and also there's always news about, well, what is going to happen to my pension? Is it necessary for me to? I always say it's important for people to continue to contribute towards their pension schemes. Contribute more if you can, because over time, the inflation of your wages are going to go up, and all this is going to balance out. It's more the near retirees and the retirees that we should be concerned about, and try to find a safety net for them. One alternative would be that the investment income, for instance, the allocation of the returns more towards the retirees and and the near retirees to ensure that we protect their contributions, and also we protect the pension that they get so that they can have a good standard of living in retirement.
And these are quite, interesting times, in the world with sky-high inflation, globally. And I'm sure this might not have been experienced, by, pension fund administrators and, players in that industry. What do you see, going forward?
Okay, so the major driver of this, let's just break this down, is because of the war in Ukraine and the imported inflation that has come in. Now, in Nigeria, we've got a second scenario, which is the inflation, the elections that are coming, and you normally get a slowdown in the economy around that time, the time of the elections. So what I would say is this is a temporary phenomenon. Over the next year, maybe we are going to continue to experience the impact of high inflation, global slowdown. But I believe that it's part of the economic cycle. I'm very optimistic that we are going to get back to normal times soon.
Right. And obviously we've seen, pension contributors, they've been able to move from one, PFA to another. They've been given that leeway. How's that going?
I think it's a good thing. It's a good thing. It allows pension contributors to be able to choose the PFAs that manage their funds. It puts pressure on PFAs to improve on their investment returns and their custodianship of assets. Yes, they are. Yes, they are. I mean, I think the level of corporate governance of PFAs over time has really improved. Information is available, so you can actually see which ones are performing better than others, and there's benchmarking. The only risk you have with that, of course, is that pensions are supposed to be a longer-term investment. So having that kind of benchmarking encourages short-termism. And as a result, because of that as well, you then find that it becomes very difficult for a PFA to stand out. So if everyone begins to invest in FG bonds and treasury bills, which are the most secure investments, and you decide to invest in equities, and the equity portfolio and the equity market goes against you,
right? Because we've seen a lot of downturn in those markets.
Then you stick out like a sore thumb. So as a result of that, you then get this head mentality where over time, almost everyone is moving more and more into FG bonds and treasury bills, and that level of diversification that you want to see in the portfolio is getting washed away. So we would like to see a few more of them, taking an alternative way of investing, putting in a little bit more of those alternative assets. After all, you're allowed from 5 to 10% in alternative investments, such as private equities, such as you are also allowed to invest in property, which in normal circumstances will also provide you with a good inflation hedge.
Well, not an easy time for investors globally, definitely. But I guess the younger ones might as well continue contributing. That's
yes, that's my message.
Thank you so much, Wise Chigudu, partner and insurance leader, EY West Africa. It was great having your perspective.
Thank you very much for having me.
To our next conversation now. According to latest GDP report by the National Bureau of Statistics, Nigeria's gross domestic product grew by 2.25% year-on-year in the third quarter of 2022, marking the slowest growth since the COVID-19 pandemic. For analysis now, let's talk to Gospel Obele, Chief Economist, Streetnomics Limited, joining us via Zoom. Great to have you on the program.
Thank you for having me. Good morning.
Yeah, so Gospel, I'm guessing this was kind of expected. What do you think contributed to this slow growth?
Yes, to a very large extent was expected because a series of events have played out the economy this year. We've also seen a downtime in terms of how energy prices has impacted on the cost of doing business. We've seen how inflation has hiked. We've also seen that there's been a loss in human capital productivity as well. And, overall regional and global events are also playing out and making it much more difficult, in terms of doing business and scaling economic potential for recovery. especially inclusive recovery context. So these are a critical block of narratives that have shaped the GDP performance. And however, I'm not really surprised at the performance because, in many other economies like the UK, they already slided into recession technically.
And we saw the oil sector recorded a 22.67% decline year on year in the third quarter, indicating a decrease of about 11.94 points, relative to the corresponding year. But no surprises there.
Yeah, there are no surprises there. I was surprised if anybody is really surprised at the way the oil sector has shrinked. Oil production also dropped, to a very large extent the last quarter, 1.2 per barrels. And we've also seen in recent times that there's been some form of aggressive push and growth in the non-oil block, and to a very large extent as well. Nigeria has not also done well in terms of transiting on that import-dependent oil sector-based economy. And that has not also impacted on our numbers, on the positive end of things. So we're not surprised. And the oil sector has been shrinking for the last 5 years now. You look at GDP growth, in terms of contribution to GDP. So it's expected to a very large extent. And until we get our home base right on that block, I do not think there'll be any form of increased potential to scale events or activities or however the sector may want to contribute going forward in the future.
All right, and on the other hand now, the non-oil sector, that grew by about 4.27% in real terms during this Q3 period. And the rate was lower, though, by about 1.18 points compared to the rate recorded, in the same quarter. What are the drivers here of the non-oil sector?
Yes, the non-oil sector has been driven to a very large extent by high-level fast-paced economic activities. You want to talk about technology, you want to talk about information and communications and technology. You want to talk about the telecom sector, you want to talk about finance and insurance, and major sectors that are very heavy on day-to-day consumer needs and consumer spending. So these are heavy drivers for non-oil block, non-oil sector. And we've also seen that the cluster of entrepreneurial activities that block have been resilient, and that has also built some form of shock absorber in quotes, towards how the sector responds to economic activities. And not taking away the fact that all of the economic events have been impacted in terms of downtime for the sector. But the sector has proven to be resilient over that, again, because it's a sector that thrives heavily on the law of large numbers. So that actually validates reasons why the sector has still performed resiliently, give or take, within the last 1 year.
Right. So looking at this performance now, comparing the oil sector to the non-oil sector, what do you think we should be doing going forward?
Yes, I'm not really surprised at the way it is right now, because the Nigerian economy is largely diversified. The big competition we have on the table is being able to diversify accordingly, to ensure that these sectors are a lot more productive. Majority of the effort to fund this sector has been largely done in spite of government or in spite of government policy, and the key here is enabling the key productivity drivers, for the sector. A report by the State of Entrepreneurship report released by the Faith Foundation recently talked about the fact that 99% of businesses in Nigeria who are in the non-oil sector are optimistic about future outcomes or doing business in 2023. So the good times are here, but the policy language, the efforts, the investment, and all of that by the current fiscal and monetary bodies have been put to a very large extent, to the oil and gas sector. Yes, some policies have been activated in the non-oil block, but there's a lot more that needs to be done in terms of activating it for access to market, for improved competitiveness and positioning, and also access to finance to ensure that a critical chunk of our SMEs can play in the regional space and play in the global space. We want to get to a point where we're not just producing cocoa, we want to be able to produce chocolates and ensure those chocolates are competitive in the UK, in Zurich, in South Africa, and people from all over the world are buying Nigerian chocolates because they love Nigerian chocolates, but the quality and the quantity or the value in which, the value it creates and all of that. So by the time you put all that into context, there's always some improved financial foreign exchange receipts and even brand reputational returns for the country. And I think the non-oil sector has what it takes to unlock that for us going forward. However, we need to unlock the productivity drivers. And consistently also to add, in H1 2022, we also saw that the non-oil sector block contributed 1.1 trillion naira more in terms of revenue, compared to the oil sector. This is in spite of efforts by the government. All right, so there is a lot of potential here. The service sector holds about 2% right now of the Nigerian economy. Previously, it was 7%, but dropped 2%. That's to show that Nigerians are doing this for themselves in terms of facilitating self-reliance and push to prosperity, as it were. So the competition now is really to unlock these different streams of productivity. I do not think we have data on the number of web developers we have in Nigeria, or the number of creative designers, or even data on those who work freelance, in terms of working from Lagos and earning in dollars, working for companies abroad. Nigeria needs to do more around the service sector in terms of organizing that market and formalizing it enough for productivity. So we have a lot of low-hanging fruit on the table. It's just for us to unlock the potential, the will and the strategic capacity to unlock it.
Right, and we might as well tag, 2022, the year of, rate hikes. Globally, we've seen, the U.S. Fed raise rates, Bank of England, and back here too, we saw at the last meeting, the MPC also raised rates, but, by a slower, less aggressive, level at the last, meeting. How is all the rate hikes? How's it playing into all of this?
What's happening to a very large extent, especially also in the global space, is that the rate hike is reinforcing or strengthening financial markets. And we've seen to a very large extent that that's also happening at the expense of the real sector. And when you look at the GDP composition and how the GDP works, especially in Nigeria and many parts of the world, the economy is largely driven by the real sector. So when you talk about recession, you're talking about the fact that the real sector has suffered a loss from increased cost push impact on the local economy. So the rate hike may have served in terms of conventional instruments used to control or manage inflation. But the nature of inflation we currently deal with is non-monetary and largely requires, yes, interest rates as a necessary tool or instrument, but also some form of complementary tools to serve on the sufficient block, in sort of ensuring that inflation is being brought down and, there's a reduced cost of impact on businesses as well. So I do not think that interest rates have really yielded the results that's been desired, but however, it makes sense for a conventional push as an instrument to control it, because a lot more needs to be done. That's my argument. A lot more needs to be done to drive down the cost impact on doing businesses. It's a lot more difficult for the average Nigerian to borrow. The cost of borrowing has gone up. Access to credit will become more difficult and more harder, because with increased interest rates will also come increased internal controls. I will see a possible dollarization of the Nigerian economy due to the redesign and all of that. So the central bank is likely to come down hard on more internal controls, by the commercial banks. That's gonna worsen the context of credits and how credits are being made available to the real sector. So in my own opinion, I think we need a much more complementary and collaborative tool approach, sort of like a tool mix, to help us unlock the potential of the non-oil sector vis-a-vis the context of inflation we are faced right now globally in the world today.
All right. Well, what are your expectations for the fourth quarter?
Yes, so for the fourth quarter, we expect a further decline to a very large extent. And that's because in recent times, we've seen how economic events have sort of like crunched heavily on the Nigerian economy. We've seen how pre-elections, and the economics of the elections have worsened, policy decision making and, just some form of reactive pressure on the economy. We also seen some form of panic engagement due to the redesign of the currency. And that's also further worsened the exchange rate. Then more recently, we found out that there's been a flood crisis, which will likely lead to food prices and then circle back in terms of increased cost of living pressure on the average Nigerian. By the time you put all this into context, there's a likelihood that cost of business go high, and then human capital productivity would further worsen. All of these events will further slow down economic activity. And let's put into context that the GDP does not tell us about productivity. It only talks about economic activity. However, like I mentioned earlier on, unlocking the right productivity drivers will help us move from just activity-based economy to a productivity-based economy. So we hope for the very best, but all of the times we're in has proven to us that the Nigerian economy is really in a dire state and that needs some form of attention, some fixing, and some structural reform and policy targeting and policy engagements as it were.
data shaping investor sentiment?
Sorry, I didn't get that, please.
How do you see the data, shaping investor sentiment?
Yeah, so far, I mean, it's not been looking good. We've seen how Fitch and Moody ratings have downgraded the Nigerian economy recently, and also a lot of, in many cases, firefighting, policy positioning of the central bank, has not also helped. And the fact that Q1 is going to be largely around the elections, that's going to impact heavily on the outlook and in terms of uncertainty and all of that for investments and doing business. So I think that it's high time the fiscal side took the stage, to relax whatever is going on in terms of reassuring the market and then introducing policies that counter political correctness, to encourage a more positive outlook around investors' confidence and keep starting the economy back again, towards a much more inclusive, productive-driven growth, as it were. Yeah.
All right. Thank you so much. That was Gospel Bele, Chief Economist, Streetnomics
Thank you so much for having
Limited.
me as well.
Join us, advisor. Thank you so much.
Thank you for having me. Have a great day. Thank you.
You too. All right, now let's take a look at what's happening in the markets now. We have Aniete with the details, and obviously, Aniete, it's still good news, in the equities market.
Good morning,
not
buddy.
A big 0.81% for the 6,006, not looking bad at all.
Yeah, not looking bad, particularly when you look at the all-share index crossing back to that 46,000 level, which you saw sometime in September. But then in just one day, that's how it was propelled by Boa Cement and Dangote Cement, which they added about 680 billion naira to that market. But I would tell you that yesterday's gain was just, it wasn't too remarkable because just two market makers, the likes of Boa Foods and Airtel, were the major reason. Otherwise, the green that you're about to see
and
there.
I did say, yesterday in the report that it could be a bear market rally.
Yeah, well, you're not far from that fact, especially when you look at the macroeconomic environment. It's not too encouraging for investment. But at the same time, you also have some people who like to cherry pick on some stocks, some defensive stocks, some seasonal stocks. So that's all about the market. So let me give you more details about Thursday's trading session. Now, this is how Thursday's trading session closed the day, 0.81%, which means in Naira terms, what you had here was about 202.93 billion naira added to the previous 710 billion naira, which was recorded in midweek or Wednesday's trading session. Now, let's take a look at the sectoral performance. There you see there, the Reds have it all across board. It was massive profit taking, and that's because the market had gained in the previous session before what you see here. Now, the Fugas, what you call the Fugas, the tier one lenders, the likes of First Bank, Union Bank, UBA, Zenith Bank, Access Bank, and GTCO, they were the ones responsible for the 1.37% decline that you see on the banking sector counter there, as well as the oil and gas counter. When you take a look at it, it's down by 1.86%. All of them are in the red. Now, the gain that we saw was largely driven, like I mentioned earlier, was largely driven by the likes of Airtel, Boa Foods, ETI, 16 gainers against 23 losers. The losses were driven by Nestle, Oando, GTCO, First Bank, Access Bank, Zenith, Lafarge, NGEX Group. So that's what you had the market spilling on this sectoral performance. Now take a look at the activity chart. Activity chart in terms of volume, the volume of activity, it was down. Let's take a look at the activity chart there. So in terms of activity, the activity was down by 26.24%. Value was up by 17.84%, while the deals was down by 0.69%. Now let's talk to our analyst, Oluwaseun Dosumu, who is the head of investment research at Parthen Securities Limited. Thank you for joining us, Oluwaseun.
Thank you. Thank you. Good morning.
Okay, yeah, of course, we are still reveling in this market rally, particularly when you look at Wednesday's trading session and then a spillover, maybe like a lucky spillover into Wednesday's transaction. And this is coming just as the central bank raised the interest rate to 16.5%, which was expected to maybe dampen investor sentiment. So now, can you bring us up to speed with why investors decided to, pump in money into the shares of Dangote Cement as well as Boa Cement on Wednesday?
Okay, thank you so much for that question. Like you already know, after the session on Tuesday, the Monetary Policy Committee decided to hike interest rates to 16.5%. And as such, you know that whenever interest rates are high, that affects the performance in the equities market. However, we saw that investors decided to still take positions in the market. This was largely due to the corporate announcement of Dangote Cement declaring or putting out the announcement that they're going to do a share buyback. And we know that whenever that happens, the price of Dangote Cement always moves up. And we saw that Dangote Cement actually increased by 10% that day. And as such, even yesterday, we saw that generally the market sentiment was actually, the overall market sentiment was actually negative. However, due to position taken in Airtel Africa, Boa Foods and Nigerian breweries, the market still closed in the positive. Airtel gained by 6.3%, yes. Airtel gained by 6.3%. That was the key driver to the positive move that we saw yesterday. Generally, if you look at the trend, you see that when the Monetary Policy Committee started to hike interest rates from May, the market activities has actually been, activities in the equities market has actually moved south. So from that point in time, that's you have June, July, August, September, October, the market has actually been in the negative. But this month of November, we've seen that despite the hike in interest rates, investors have seen some value in the market. So they are positioning ahead, like making dividend plays ahead of the likely dividend announcement or declaration at the end of the year. A lot of these stocks, their earnings have been better than what they did last year. A couple of them have done way better during the third quarter. They've done above 90% of what they did for full year 2021, just during the third quarter alone. So with that in mind, that would tell investors that, it's a good time for them to take position in these stocks, even though we have the general macroeconomic headwinds. The fundamentals are still quite sound. The valuations of these stocks are still quite cheap. So the smart thing for investors to do right now is to take positions ahead of the full year release and ahead of the dividend declaration, which is what we've been seeing in the market.
Okay, thank you, Oluwaseun. So now we will keep our eyes out on how Friday's trading session ends the week as we count down to the end of November. So thank you so much. That's Oluwaseun Dosumo, the head of investment research at Patient Securities Limited. Now, before we go, let's take a look at the fixed income market. This is how the fixed income market, the bond segment of the fixed income market turned out. At the end of the day, it was bullish. Average yield there contracted by 7 basis points to about 14.4%. But when you look at the board here, the total number of deals, the highest concentration was here, 26th of April, 2029 paper, and the total number of deals carried out for that segment is 15. Moving over to the Treasury bills market, it was rather on the bearish side. Total number of deals was highly concentrated on the 23rd of November paper, 2023, which is 7 deals, and the total number of deals carried out on that market, 55. Now, we will be expecting that next week, the impact of the FAC revenue distribution by the federal government, by the FAC to the 3 tiers of government, will be focused for investors for next week. So, Ladi, that's it for the market. Right. We'll be giving much more information. As
fingers crossed for today's close for the equities market. Be watching out for that.
Well, fingers crossed. I guess the market is still might make some retreats from what I saw there.
Okay, your crystal ball.
That's what my crystal ball says.
All right, thank you so much, Anete. Still watching Business Morning live on Channel Television. Let's head on now to the UK. We have Juliana standing by right there. Great to have you, Juliana. So we got that data today. So the number of cars produced for the UK market about 12.5%, and the number made for overseas also up 6.3%. But it's returned to growth, but still below pre-COVID levels.
Good morning, Laddie. Still below pre-pandemic level, yes, but I think anyone within the industry will be pretty pleased by the data that was released this morning by the Society of Motor Manufacturers and Traders, showing that last month 69,500 cars were manufactured here in the UK. That's an increase of about 7.4%. This is very, very good, because we know that over the past, I'd say probably about 24 months, you know, the output from car manufacturing in this UK has really ebbed and flowed, but very much contracted. There were so many issues. I'm sure you remember the global chip shortage issue that shut down so many plants, and of course COVID, and not just COVID in terms of the restrictions, but a pingdemic that really impacted car manufacturing here in the UK. So it's a really good sign that things are on the up. We are seeing an increase in purchases of electric vehicles. We know that there is going to be a ban in the UK from 2030. There will be no new petrol or diesel cars made. They will all be electric. So the industry is really trying to shift as much as possible. We're also seeing lots of purchases of hybrid vehicles, so those that you can top up with petrol and also plug into a battery. So that's good. As you were saying, in terms of export, our main export destination is the EU. However, we are starting to see more business focus in the US, Japan and Australia market. So yeah, not bad data this morning.
Not bad at all. I also saw that that report that the UK has banned about Chinese surveillance gear, you know, from sensitive state premises. Tell us more about this.
Yeah, this is a pretty interesting story, actually, and I think it's something that's likely to grow over the weekend. There has been some research conducted by a cross-selection of party MPs, just looking at Britain's relationship with China. It has been under surveillance, no pun intended, over the past couple of years, but it's become more acute since China imposed this national security law a couple of years ago because of the riots in Hong Kong. And now research that's been conducted by some parliamentarians has actually revealed that about 40% of UK police stations are actually using surveillance systems which have been produced by Chinese companies. There's one company in particular that's been pointed out, which is Hikvision. They also provide so many CCTV cameras for schools and hospitals, and Oliver Dowden, who's quite a prominent cabinet office minister in the UK, says it's just completely unacceptable, and they believe that some of this equipment is being compromised, which is a very serious allegation. I'm sure we're certainly going to expect some sort of response from the Chinese ambassador or the Chinese foreign ministry when they do their daily briefings. So they've been asked to be ripped out. They want them to be ripped out of the entire UK so that Hikvision and any other Chinese security surveillance manufacturer just will not have access to some pretty, I would say, places that shouldn't be receiving any Chinese disinformation.
All right, I guess we'll keep tracking that story. Thank you so much, Juliana.
Thank you.
All right, that was Juliana. They're giving us the details from the UK. Now let's head on to other markets to see what's happening in the crypto space there. We see the market still going through that turmoil. I would call it extreme fear in the market, 20 points. Just like we had yesterday, still extreme fear in the crypto space, you know, at this time. Let's look at the market cap, still that FTX issue weighing on the market. Look at the market cap there, we see 1.38%, that's the downside there for the market cap. Was getting to that 850 mark, but got pulled back there. Volume traded down 22.47% this morning. We see Bitcoin dominance there, 38.22%. It's been on that level for a while now. Let's look at the price of Bitcoin this morning, 16,425. We know it did breach the 15K level the last time, started an uptrend, but we're seeing a pullback. We know Fridays, normally we see some kind of sell-offs, and it's happening already. And obviously it's a Black Friday, so we're not getting discounts for cryptocurrencies at this point. Volume traded $24.63 billion. Let's look at Ethereum, still holding that $1,000 level, was down 1.83%. Volume traded lower than what we're used to at this time, $9.09 billion. If we look at the top alts by market cap there, we see it's just XRP there. That's the only gainer on that counter, up 8.26%, 41 cents. Did break that 36 cent resistance level, and now at 41 cents. All right, let's bring in Amari Sachet now. Tell us what's going on with block confirmations in the crypto space. Hello, Amari. Hello, Amari. I think you might have to unmute.
Sorry.
Okay, fantastic. Yes. I can hear you now. I can hear you now, Amari. So we did get that news that you could now deposit, XCC, into centralized exchanges with one block, confirmation. I knew it used to take a long time before. Tell us about this.
Yeah, so as you know, earlier this year, we deployed the avalanche consensus algorithm, and it allows to protect the network against what we call 51% attack. So 51% attack is when there is not enough hash rate on the network, there is not enough miner mining the network, then it's possible for a hostile miner to, undo some transactions that were confirmed effectively. And with the avalanche consensus algorithm that we deployed, a few months ago now, it's not possible anymore. And what we see right now is that various centralized exchanges, also various, payment processors and stuff like that in the space, I started to notice that feature, and they are enabling one block confirmation, which means that if you send the money on an exchange, you've got to wait 10 minutes on average, and then it's done. And you can use the money on the exchange, and same wise when you withdraw.
And how does this, impact, the network and traders?
Well, it offers, so for trading specifically, it offers traders possibility to move capital from different exchange faster. We knew, for instance, that this is one of the biggest use case for Litecoin because it has faster confirmation time than Bitcoin, but now we can beat that. Generally, the more people are able to move their money around the way they desire and the way they want to, and they can do so cheaply and quickly, and higher the utility of the chain is, right? So we are very much aiming for that.
All right, Amari, if looking at the market now, we know, Bitcoin is looking for some kind of, direction, either up or down. But what are you seeing in this market right now?
I mean, what I'm seeing is that, we've been in the bear market for a few months, and it becomes more and more unsustainable for the actors that were not properly backed, during the bull market to sustain their business. And this is a cycle that we see repeating every few years. People become over enthusiastic, they, spend too much or get over leverage or whatever. And then we need to go through a period where all those actors will go bankrupt, before we can go back up again. And this is what is happening right now. It's always a bit unfortunate. It's always rough times, but this is a natural part of, the market cycle. And this is also like a necessary step before we go back up again, right? Like all those bad businesses, all those bad investments, they need to, they need to be weeded out of the market so that we are on the same pace and we can, go back up again.
It's funny how traders never get used to these market cycles. It's always a surprise when the bear market comes. Thank you so much, Amari Sachet, eCash.
Thank you for having me.
Thank you. All right, let's look at the top gainers this morning. Let's see who's topping the counter. XRP there. That big move this morning, up 7.83%. See BNX, HT there, who will be talking up 2.79%. Single-digit gains, not as expected in the crypto space at this time. Top 5 losers counter now. Let's see who's topping the losers counter. We see it's Leo token there. It's down 8%, and Clayton also down about 6.08%. XCM, one of the oldies there, 3 cents, down 6.01%. So not much going on in the market today. We're seeing a bit of a pullback. All right, that's it for the market analysis, talking about the crypto space. And that's it on the program today. Thank you so much for watching. Don't forget to join us by 1:30 on Business Incorporated for more updates and developments in the world of business. And you can watch this again on our YouTube page. Just flip over to YouTube, search for Channels Television, flip to our videos. You can watch all our productions. Thank you for watching. I'm Ladi Williams. Bye for now.